We've all been through the hype cycles. Crypto, NFTs, Web3, they all had their big moment, and then, well, they crashed. So now, the question dominating the financial world is pretty simple. Is artificial intelligence next? The buzz is absolutely everywhere, but so are the warning signs.
Look, there's no doubt AI promises to reshape our world, and investors are pouring billions in to make it a reality. But all this frenzy is making a lot of analysts really nervous. So, is this a genuine revolution we're living through, or are we just watching history repeat itself? That's the core question we're going to dig into.
Okay, so to really get a handle on the risk, we first have to understand the sheer scale of this boom. Ever since ChatGPT launched, the world has been in this AI-fueled frenzy. It's like a modern-day gold rush, where investment logic has kind of been tossed out the window, replaced by pure momentum.
So the whole thing really kicked off back in 2022. OpenAI unleashes ChatGPT and boom, it becomes the fastest-growing digital product in history. We're talking 1 million users in its first week, 100 million in just a few months. In what felt like a flash, AI went from science fiction to a massive global craze.
And you know what happens when something gets that much attention, right? The money comes flooding in, and I mean staggering amounts of it. By 2025, global corporate investment in AI is projected to blow past $330 billion. It's like, almost overnight, every company on the planet felt this pressure to become AI-powered.
So who's the biggest winner in all of this? I mean, where's all that cash actually going? Well, this whole craze has one undisputed champion, the chipmaker NVIDIA. Their advanced chips are the essential hardware. They're basically the picks and shovels in this new digital gold rush.
And that demand has sent their value into the stratosphere. At its peak, NVIDIA's market capitalization has been bigger than the entire economies of countries like Canada or India. I mean, think about that for a second. A single company representing a massive slice of the entire global stock market. That is the incredible scale of this boom.
But for a lot of economists, all this frantic energy and these sky-high valuations, it all feels eerily familiar. It really seems to be following an old and potentially very dangerous pattern.
The parallels are just striking. Back in the late 90s, the big story was the internet will change everything. Sound familiar? Today, it's AI will change everything. Speculative darlings from back then, like Pets.com, have been replaced by today's giants like NVIDIA and OpenAI. And we all know how the dot-com era ended, in a massive market crash. The big question is whether the AI boom is headed down that same path.
So, is this all just hype, or is there a systematic way to actually diagnose a bubble? Well, economists Brent Goldfarb and David Kirsch outlined a great framework in their book Bubbles and Crashes, and they identified 4 key signals that can turn a real innovation into a speculative frenzy. Let's see how they apply to AI.
All right, here are the 4 signals. First, you've got uncertainty. That's when nobody really has a clear, profitable business model yet. Second, you see a ton of pure play companies. These are new businesses built entirely on the new technology. Third, there's an influx of novice investors, driven more by hype than by solid fundamentals. And finally, you get a powerful narrative fever, with these grand stories promising the technology will solve all of our biggest problems. When all 4 of those factors combine, that's when innovation can really start to overheat.
Let's just focus on that first signal for a second, uncertainty. Billions have been invested, yet a recent MIT study found that a whopping 95% of companies that are adopting generative AI have seen no measurable financial return from it. The computing costs are just so incredibly high that even a product as popular as ChatGPT is reportedly losing money on many of its user queries. But wait, if the profits aren't there, then where is all this incredible valuation coming from? Well, this leads to one of the most concerning parts of the AI boom, this strange self-fueling loop of money flowing between just a handful of major players. In the first quarter of 2025 alone, a massive 60% of all global venture capital funding went to AI startups. So the crucial question is, what are these companies doing with all that cash, and where is it actually ending up?
It seems to start with the biggest player in the game. NVIDIA, the chip maker, is investing billions of dollars directly into the very same AI firms that are supposed to be its customers.
And here's the twist. Those AI firms then use that very same investment money to buy the essential, high-demand chips from, you guessed it, NVIDIA. It's a circular flow. Money goes out as an investment and comes right back in as revenue.
Economists actually have a name for this: mutual leverage feedback. It's a cycle where one company's spending artificially boosts another's bottom line. This creates the illusion of explosive organic growth, when in reality it's an interconnected loop that's overheating the entire market.
So the crucial question is, what happens if this loop breaks? If this bubble does burst, the consequences won't be contained to just Silicon Valley. The fallout could shake the entire global financial system.
This risk is magnified by how concentrated the market has become. This chart shows how much of the S&P 500's value is tied up in just a few tech companies. Today, that concentration is at nearly the same dangerous level as the peak of the dot-com bubble. A handful of giants are driving the entire market, and they all share one common risk factor: AI.
If investor sentiment suddenly turns, the dominoes could fall fast. A spending freeze on AI infrastructure could create a GPU glut, where the supply of chips suddenly exceeds demand. A credit crisis could be triggered as AI-linked loans start to default. Trillions in paper wealth would simply evaporate. And ironically, even as AI valuations crash, companies would likely accelerate automation to cut costs, meaning layoffs would continue.
The ripple effects would be global. For a major economy like India, a crash would mean immediate pain. Its IT services sector would face project slowdowns and startup funding would dry up. But paradoxically, there could be a long-term benefit. A crash could create a watch-and-learn window, allowing the country to adopt proven AI technologies once the hype dies down and the costs come down.
And this brings us to our final thought. No one is saying the technology of AI isn't real or powerful. The internet was real too, but the bubble was also real. So this leaves us with the ultimate challenge. When a genuine technological shift and a speculative financial mania look exactly the same from the outside, how do we tell them apart before it's too late?